JBlog, 25th of January 2010. Starting out with the S&P 500, as I usually do. Of course, the last 3 days have been quite dreadful for the market. Especially Friday. Friday was a surprise. Friday was a surprise even to me, even though I obviously did expect this move to happen eventually. But just when it finally happens, you sometimes think that, oh, is this it? Is this really it? Or is this just another one of those? And of course, it could be another one of those. But the important things that have happened, I think the most important thing is the break of this trend line here and how this red bar finished um, right down here. So unless we get a gigantic reversal on Monday, we could very well see the 1030 crossover, and we could very well be looking for some down days and perhaps a downtrend to happen, and we'll see how long that will go. Um, so this particular, and I mentioned on Twitter, this particular trend line that got penetrated here started back in June, July, and it had one, two, three, four, um, four times touched, and then of course went away quite a ways, and now went through that. Now obviously trend lines are an imperfect science, so we'll see if we can follow through. This other trend line had been penetrated already quite a while ago, so we'll see how that continues. Now of course Money Watch is suddenly full of bad news, um, and correction may be looming, maybe, we'll see. But it was definitely not a very pretty day there on Friday. From a TED spread point of view, um, it doesn't look that horrible quite yet. The TED spread has actually decreased mostly, um, but the important part here is the VIX. Um, Fear has once again entered this market with a vengeance. This is a crazy market. I mean, this is an insane market where just we go along here, not a concern, nothing bad can happen, and poof, there it goes, fear. Weird. Now, the news, of course, blame this on Obama's banking. Um, I personally think it's completely unrelated to banking. It might have been a nail, but as for banking, banking doesn't add anything to the economy. It doesn't add anything to the recovery. A bank is an institution that takes money from other people, much like the government really, and doesn't really produce anything that is of value to anyone. So from that point of view, bank business does not either help, if anything, it hurts recovery, is for banks to make good money. Oil. Oil has not yet penetrated the down trend that was set in motion here, but it is certainly close. That could be interesting. Natural gas has not moved much. It's pretty flat. Gasoline has dropped. This right after a Market Watch story that gasoline will go to $3 next. That's always interesting. Gold over silver index. This is interesting because it flags possible recession fears again. A gold-silver ratio of over 66 is something to be concerned about, simply because gold is capital preservation while silver is mostly a monetary metal. So when gold outdistances silver too much, then that basically means that um, electronics basically isn't that important anymore, because that's where a lot of it is used, electronics. Going over to the New York Composite, we have uh, this sideward move here in late December is either penetrated or almost penetrated on the New York Stock Exchange side of things. It is penetrated almost. It wasn't as level here, but it's almost penetrated on the S&P 500, and then of course if we scroll down to the Dow Jones Industrial Average, that support here has been destroyed, and the Dow Jones is about to cross the 1030. So those are definitely not good signs. What else do we have here? Core sector. This is the internet index, um, and that has definitely it's a very long running, very straight index. It has been that trend line has definitely been destroyed, and there was actually a 1030 crossover right here. So that's something to be concerned about. The other thing to be concerned about is the retail index, another one of those that has been really nice and straight, destroyed, crossed over in the last 2 days. And from our core sector point of view, the one that interests me the most, simply because I've got some puts on it, is the consumer discretionaries. Now the puts haven't moved yet as much as I would like them to. Realistically, they've dropped. The stock has dropped by almost $1, and the options have moved 10, 15 cents at the most. So I'm a bit disappointed there. But of course, if the underlying stock stays down here for a while, and the options will eventually catch up, and yeah, that'll be good. Then we'll be making some money. Other things we have, I think I talked about this one before. The current P/E ratio, according to Yale, Robert Shiller, and basically the P/E ratio has dropped. Last week it was 20, now it is 19. If we look back here, Black Monday, it was also in the neighborhood of 18 to 19. This drop that was in 1987 doesn't really look that big from here, does it? But it certainly scared a lot of people. It was interesting. I am still worried that something like that could repeat itself, some drastic drop, just because when we're looking at the PEs, the PEs have a tendency to want to come back somewhere into this area. This is where the real value is. Once stocks drop back into this 10 or below, 8 or so, then they can rally for a very long time after that. If they don't go back all the way there, then rallies are not as solid. But of course, this is the inflationary stage that we had, so that kind of messes things up, is the money supply. Anyways, interesting will be what's going to happen on Monday. I have no idea. It'd be good for me if it went down further. It'd be bad, obviously, for everyone else. But I don't make the rules. I just try to follow them and make some money along the way. Hope you have a good time and make lots of money next week. All the best. Bye.